Live from the City of London for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
Live on TV and radio for our audience worldwide. Good afternoon. Good afternoon. The countdown to the Fed decision starts right now. 27 minutes away, TK. Your equity market slightly positive and yields very close to cycle highs.
Here from the fog of London, it's Dickensian out there right now.
It's surveillance after hours, TK.
Yeah, we're going to see if we get some clarity from Jerome Powell. He's dealing with the fog of the American economy. A lot of cross currents here. I'm really interested to hear what Kathy Jones says about what yields tell us right now.
Looking forward to that conversation, TK, and so much more. As you know, Tom, it's a three-part act. Decision at about 28 minutes. Bunch of forecasts as well. Then on to the news conference about an hour away.
Well, the news conference is going to be different. And again, we're going to go to November. And what I saw from our guest this morning on surveillance was a real tendency to look to December. How does he frame in that press conference the forward view? The people in the room are less concerned with September and the dots. OK, but I'll give you that, John. I don't care about the dots. But the answer is they're going to go to November and they're going to go to December.
Andrew Hollenhorst, Citi, looking for that hike in November. Hollenhorst joining us a little bit later. This is how the stage is set. The price action looks a little something like this on the S&P 500. Equities are higher by 0.2% on the S&P. Yields are backing away from cycle highs. We're down about 4 basis points today to 431.67. I've gone through the three-part act, the decision, the forecast, the news conference. This is the two-part act of this show. Going into that decision, coming up, Morgan Stanley's Jim Keren, Deutsche Bank's Matt Lazzetti, Kathy Jones of Charles Schwab out the other side after 2 p.m. when that decision drops. Here's the lineup for you. Citi's Andrew Hollenhorst, Diane Swank of KPMG, Jim Bianco of Bianco Research, TK, Greg Peters of PGIM.
It's going to be interesting to see. Jim Bianco's maybe the most holistic there, pulling in the markets with the economy as well. And I go back to the Arch Bianco call, now hugely prescient about the longer, and that inflation comes down to where we are and goes flat or even with a little bit of an uptick. At the time, that was controversial.
And the ultimate contrarian call that maybe yields just have to go higher from here.
Well, that's
hearing that from Jim,
yeah.
We'll ask that question to Greg Peters of PGIM. Is this a buy in this bond market, TK, with a 10-year where it is, where the 2-year where it is currently as well?
It could break either way. And, again, I think Powell will give us some direction. He's going to be cautious. He's going to say, this is what we see now. But, again, I'm going to go to the gaming out of this into November, December. And, John, quickly here, that's going to come off those dot plots. That middle range here from the announcement to the press conference, the analysis by Mike McKee of those dots is key.
The median dot for 23, for 24, the growth projections, we're expecting them to mark to market. Essentially, growth has been better.
Yeah.
Their forecast might have to come up. Inflation may be a little bit softer, but I'm with you. Where do they see rates beyond November into next year?
Not expert at the dots, but certainly expert at the bond outcome. Joining us now to get us started on the special show from London is Jim Keren, to say he's Portfolio Solutions Group CIO at Morgan Stanley Investment Management's important. What you have to understand is after the physics of Bowdoin, the physics of Caltech, he knows the physics of Jerome Powell. I'm baffled, Jim. Is this meeting about today, or are you looking already to November and December?
Thanks, Tom. Look, I don't think this meeting is about today. As you put it, this meeting is about November and December and what he messages. Look, if we break it down this way, very, very simply, 2023 is about the Fed cycle coming to an end and them getting the job done to do enough to get inflation down towards target and keep it anchored there. 2024 is about holding rates higher for longer or potentially even cutting if economic conditions seem that it's likely that they need to do so. So the market will have no patience for rate hikes, further rate hikes in 2024, because if that's happening, then that means the Fed has missed something, inflation is accelerating, and that they're going to have to do something more drastic to bring inflation down. So I think if we look at this more broadly, we need to see in 2023 the Fed get the job done. So look, as far as the way that I see this meeting's all about positioning their potential policy act for November or even December.
I look at this, and the overlay to me is the good work of your Ellen Zentner, award-winning economics, and she's marked down GDP off revisions and some actual present numbers, and she's come down a fair amount. half a percentage point of real GDP or even more. Are we on the edge of a stagflation here where we pull in from an Atlanta GDP guess of 6%, where all of a sudden GDP slows down and changes the Fed decision?
So I think that, third quarter GDP is likely to be still, relatively strong and robust. In the fourth quarter, there's likely to be some give back. But I think Ellen's onto something here, though. I think the markets are going to start to read through this, and they're going to say, like, look, third quarter GDP, some good technicals, things are strong, but this might be the last big thrash in the economy before it really starts to slow down. Now, if we think about this from the Fed's perspective, this is what rate hikes are supposed to do. You're supposed to see a slowdown in GDP growth, a slowdown in inflation, slowdown in wage growth, and everything, and even housing and everything else. So the goal here for the Fed is to get inflation down and keep it anchored and keep it down durably. Just getting a slowdown or potentially even a mild recession, yeah, that could help in terms of bringing inflation down. But the point is that they have to keep it anchored, because what could start to happen if they don't is by the middle of 2024, the year-over-year base effects might make inflation start to reaccelerate higher. So it's imperative for the Fed to get inflation under control between now and the middle of 2024.
Jim, Bruce Kasman, JP Morgan, on the program with us a little bit earlier on this morning. Bruce Kasman said that 2024 projections were aspirational. They were aspirations. And the idea that we can get inflation back to target without doing real damage to the labour market is aspirational, fanciful. Jim, do you agree?
I do agree. Now, target is 2%. Do I think we're going to get to 2% and stay there? No. Will the Fed take a victory lap if we get between 2 and 3% and it shows that it's stable and it's not accelerating above 3? Yes. I think that, what it would take for the Fed to actually get inflation at 2% and keep it there would probably be much higher policy rates and very likely a hard landing. I don't think that's what the Fed is aiming towards at this point. So I think we have to look at growth in 2024 as certainly slowing. We just can't see the acceleration of inflation. And I think, therefore, at that point, the Fed would likely be happy with their policy actions and likely be able to keep rates high. Look, just because rates are high and they're not cutting, it doesn't mean that they're easing. Rates are still impacting the economy, and there's about a 9-month lag, and that is yet to be seen going forward. So I think that the work that they're doing in 2023 needs to have enough speed to keep momentum going to bring inflation down to last them through 2024. And that's why a November hike or a December hike is still likely on the table in their eyes.
Jim, I don't know what Chairman Powell says in the news conference about 50 minutes from now, but I can share with you, offer you a sneak peek at a Mike McKee performance in that press conference. Mike McKee told us this morning, this is the question he wants to ask: how much confidence do you have in anything that you are telling us today? Jim, when we hear the words of Chairman Powell, how much confidence does he have about the future?
I think he is making an educated guess like the rest of us. I really think that it's very, very uncertain right now. We're having a very unusual economic cycle at the moment. The unemployment rate has stayed very low. Wages stay relatively robust. So it's hard for us to think of having a deep downturn or a recession. Typically, at this point in the cycle, we would be really, really primed to have a deeper recession and everything else. The markets are just not functioning that way. So I think that the Fed's stance on this in terms of just being very, very cautious in terms of how they proceed is very, very important. So when the Fed says we're data dependent, what they're really saying is we're not sure. We're not 100% sure as to how things are going to develop and what our actions might be. I'm always going to go back to this one point, Jonathan, which is that the Fed needs to get inflation to a level that they're comfortable with. And to me, that's like 2.5%, maybe 3%, somewhere in there. But make sure it stays there, that it doesn't start to reaccelerate higher. So it gets anchored at a lower level. Anchored at a lower level. That's the absolute key. If it starts to reaccelerate, that's bad for everybody, and they just need to take the steps today to make sure that that doesn't happen in the future. And I think that's the balance of risks that they're playing with.
Hey, Jim, stay close, stick with us. This is great. Jim Karen there of Morgan Stanley. Jim's going to stick with us going through to that decision. Joining us in just a moment, Matt Lazzetti of Deutsche Bank, Kathy Jones of Schwab. Looking forward to those conversations. TK, the words of Jim Karen there, when he says, and he being Chairman Powell, says we're data dependent, to some extent he just means we don't know.
Well, they're back, and I go to the dual mandate. They're not only data dependent on what the job market does, which has been booming, everything considered, but also data dependent on a quieter GDP. And we really haven't seen a tepid U.S. GDP yet.
Looking forward to the Mike McKee performance in the news conference in about 50 minutes' time. Three-part act, you know it well. We're going to get a decision, some forecasts, and a news conference a little bit later this afternoon, all in the next hour. Live from London, this is Bloomberg.
The Fed will do what we all expect it to do.
So they'll pause.
Pause.
Hawkish pause.
A hawkish pause.
The pause, but an indication that they're prepared to do more.
They'll keep wide open the possibility of another hike.
Emphasize that November continues to be a live meeting.
One more rate hike has to remain on the table.
Chair Powell is going to say that they are remaining vigilant.
They'll make it very, very clear that they are still data dependent.
And they're going to push back against this notion that they'll be cutting anytime soon.
The big question mark is, are they going to do something in November?
What do they do November 1st, their next meeting?
I think that the Fed is done hiking rates.
We see inflation coming down.
They're going to raise rates in November.
The economy is still very strong.
It's a really tricky needle to thread in terms of doing just enough, but not too much.
November, we'll see what happens.
Whether this is going to be a skip or a pause is to be seen.
Well, it took us at least 15 minutes to say it, but we're saying it. Hawkish pause is what is widely expected, a phrase overused over the last month or so in anticipation of this particular Federal Reserve decision. If you are just tuning in, welcome to the programme, live on TV and radio. This is a Bloomberg surveillance special, counting you down to a Federal Reserve decision for the month of September. That decision is about 15 minutes away, and the price action is shaping up as follows in the equity market. On the S&P 500, almost totally unchanged. We're positive by about 0.1% on the S&P at the moment. On the Nasdaq, we're negative by 0.14. That's how the session is shaping up currently. Of course, that can all change with the decision in just a moment, alongside the forecast, together with a news conference from Chairman Powell, which starts in the next hour or so. Beyond equities in your bond market, it's amazing to see it all over again. Tom, we've talked about it, how we're slowly and then quickly internalising this high for longer message from this Federal Reserve, with a 2-year still north of 5%, yields in this morning and this afternoon, and the 10-year still in the 430s, and the 30-year still around 440.
In 4 basis points on the 2-year at 5.05. As you mentioned, John, you were going back and forth with someone here earlier today on a 5.09 2-year yield. I think a huge body of people watching this Fed Decide special haven't yet framed out a 5.09, or, what money market funds do on the way up there, as Deborah Cunningham talked about.
It's amazing to see, Tom. And with that front end elevated, we've seen significant dollar strength come through over the previous several weeks. The euro at the moment just about holding on to 107. TK, 107.26 on euro dollar. As we near here 2 p.m. in New York and Washington, we have great conversation for you to frame out this moment. Kathy Jones joins us, Chief Fixed Income Strategist Charles Schwab, Matt Lazzetti at Deutsche Bank, and we continue with Mr. Karen. Jim Karen joins us from Morgan Stanley as well. Kathy Jones, I want to talk to you about the real yield. To me, it's ending a real rate analysis. We really haven't done that since before 2007. Interpret how Jerome Powell and his team interpret a 1.96 10-year real yield. How do they handle that?
I think the way the Fed looks at this is as an evidence that they're tightening policy. So we haven't seen it play through in the credit market. Credit spreads have actually fallen. And so the financial conditions indices have been relatively buoyant. But real yields matter a lot when you're talking about business investment or consumer spending. Ultimately, that real yield's very important. So I think the Fed is looking at that and saying, okay, inflation expectations have been anchored, but we've had almost all of this lift is coming in real yield. I think they're looking at that as, yeah, we're getting some of the tightening through in our interest rate policy. And it's maybe not in the credit markets, but it's certainly there in the real economy.
So, Matt Lazzetti, let's build on what Kathy just said. Given all of that, are we sufficiently restrictive?
Yeah, I think the Fed thinks that we're close. You know, they are likely to show another rate hike this year. Our baseline is that they don't deliver on that, that ultimately we get enough evidence that the labor market and growth are slowing into the end of the year, that they don't hike in November, December. So we're at the peak at the moment. You know, I think you're beginning to see some evidence of it for the consumer. You're seeing delinquency rates rise. And at the time where you're seeing some of these headwinds hitting the consumer from higher gas prices, tightening of credit conditions, return of student loan debt, I think these things will help them achieve the sufficiently restrictive stance that they're searching for.
Matt, you're always bravest guy in the street. You got a little narrow paragraph at the bottom of your note. On 2026, you think we converge to a normal economy, something like 2026. What is that real GDP number that you and Jerome Powell have to consider far, far out in 2026?
Yeah, look, I think there's substantial uncertainty about what the Fed's going to do through the rest of this year. There's meaningful uncertainty about 2024. There's a ridiculous amount of uncertainty about 2026. I think that is all kind of a messaging perspective from the Fed. It is, you know, is the economy converging back to what they think the long-run values are? On their view, it's 1.8% for real GDP. I think from our perspective, there's upside risk to that as you look further out. Productivity growth from a tight labor market, I think, could be materially higher than what the Fed is currently pricing in. Your own view is that potential growth is above 2%. But look, that's mostly a messaging thing from the Fed's perspective at the moment.
You're better at this, John, than I am. Do we get 2026 dots today?
I think the long dot is interesting. That's going to be the conversation around where they believe neutral is, Tom, where we will be going back to. What does that trip look like? I don't think Chairman Powell wants to have that conversation at the moment.
No, Matt Lazzetti does.
But Jackson Hole. But Kathy, to some extent, Mr. Williams over at the New York Fed has engaged in that conversation. When you look at the projections, Kathy, that come out in 10 minutes, beyond the decision, most people expect it to be unchanged. For growth, for inflation, the dot plot, what are you expecting to change? How does this shape up compared to, say, what we saw in July?
Yeah, excuse me. Sorry. I think we'll see the growth numbers revised up a little bit to reflect the third quarter bounce. And then the inflation numbers revised down a little bit because, you know, we're starting to see that core PCE pass through to the downside. So those would be the big changes I would expect, but they're incremental.
Matt Lazzetti, I know that you've got to run. We've got about 50 seconds left with you. Can we just finish there as well, Matt? What you'd expect to change in the forecast, the projections we get from the Federal Reserve in 9 minutes' time?
Yeah, I think we know it's going to growth upgraded substantially. We think it doubles this year. Core inflation comes down a bit. I think really the focus should be on 2024. It's on, you know, do they still expect inflation to be, you know, 2.6%? Do they still think that requires some pain in the labor market with the unemployment rate rising? And really, what does that 2024 dot look like? You know, we think that it comes up by 25 basis points, that the Fed needs an even higher real Fed funds rate to achieve their objectives. But I think if we step back, you know, if that is the hawkish message from this meeting, we've gone through a year where the hawkish message was upgrading the terminal rate, upgrading growth and inflation. If the real hawkishness that comes out of this is some view on 2024, you know, I think that's a hard thing to sell to the market as a terribly hawkish message.
Matt Lazzetti, thank you for joining us today. And what a great call from Dr. Lazzetti that we saw where he said, yes, recession, but out there somewhere. No one was more prescient about that than Matt Lazzetti. Jim Caron is with us with Morgan Stanley. Jim, I look at all that we're talking about here, and it comes back to the physics of going back to a normal rate environment. Nassim Taleb, the quant, said the gravity's return to the system. You're degreed in the gravity. Tell me the gravity, the physics that Jerome Powell has right now. Is it a 1994 physics?
I think we're getting close to it, right? So, I mean, you know, these rates are high right now. I mean, they're not extraordinarily high, but they're high enough to put pressure and force down on the economy to continue with the physics analogy. So, yes, gravity is going to pull this down. Look, I mean, there's a lot of things. There are a lot of headwinds in 2024 from a policy perspective. Number one, the higher rate hikes are going to start to bite. Number two, the refinancing. People talk about maturity walls, you know, that are coming up. It's going to be more expensive to do business. And number three, it's going to put pressure on valuations, right? So bond yields being higher, our Fed that's higher for longer, is going to continuously put pressure on just the broader markets, financial conditions, equity markets, I would even say. just given the alternatives that investors have to invest in bonds with a higher, potentially more attractive yield as we move into 2024. Because look, as Matt was saying, there is a recession that's out there somewhere. Whether it's a deep recession or it's a mild recession, I'm in the camp it's a mild recession, but it's a slowdown. And I think that there's going to be a bigger balance between, when we think about asset allocation, between fixed income and equity.
As Jerome Powell goes into this press conference in 6 minutes, Jim Karen, is he a single mandate Fed chairman? Is he on the edge of Christine Lagarde?
Yeah, I think his primary mandate is getting inflation where it needs to be. I think the jobs market is structurally very strong for various reasons. The big thing that everybody's talking about, what we're all concerned about the most, is can the Fed get inflation towards an area that they're comfortable with in terms of their target and keep it there. So yes, the Fed does have a dual mandate, as you pointed out. It's price stability and full employment. But I think the Fed is willing to risk it a little bit on the jobs front in order to get inflation down. So I hate to phrase it this way, but I think that a mild recession actually plays well in the Fed's calculus to get inflation down. So I think they're willing to push it and risk that in order to get inflation to target. So let's not call it a single mandate, but pretty darn close.
Do we call that a soft landing? Kathy, I'd love your view on that. We throw around these phrases. I don't know what they mean anymore. What is a soft landing to you, Kathy? What is it?
Well, I think it would be a slowdown in the economy and a reduction in inflation without a big rise in unemployment. And I agree with Jim. That's a tough thing to pull off. It's more likely we'll have some sort of a downturn in the economy if we really have a Fed that's determined to get back to that 2% target on inflation. So soft landing, seems like an aspiration, as you mentioned earlier. I think every Fed wants to accomplish it, but it's really hard to pull off.
Agreed. And I think a lot of people listening agree as well. Jim, one thing you've been fantastic at all year, I'm sure there's many, but I'll pick out one. You asked us to ask and really question what could go right this year. And when we think about risk, there is upside risk, not just downside risk. Jim, how are you thinking about that particular question now?
Yeah, look, I still think that there are upside risks. I mean, we're talking a lot about recession, but we also have to recognize that if it's a mild recession or if it's a soft landing of some sort, however we define that, earnings growth, when we think about bottoms up earnings, that's been rising. 2024 earnings around $248, $249 right now. Many people were forecasting that we would have sub $200 earnings, right? Multiples have held up reasonably well. I think what could go right is that the market looks through what could be potentially a mild recession and buys the dip quicker than what many people think. The number one question I get from a lot of clients is, I missed the rally, where can I get in? So there are a lot of people with dry powder that's looking to buy the dip.
Kathy, I want to give you the final word. What's the number one question you get from clients at the moment? Is it the same one?
The number one question I get from clients is, when do I extend duration? I've been sitting in cash forever and ever, and I want to extend duration because I want to lock in yields, but I'm afraid to move.
We hear that a lot too. Kathy, thank you. Kathy Jones, Jim Karen, your Federal Reserve decision about 3 minutes away. Said this a few times, three-part act. At the top of the hour, you'll get a decision from the Federal Reserve, a bunch of forecasts as well. Mike McKee's going to break that down for you. 30 minutes later, a news conference in Washington, D.C. with Chairman Powell. Plenty of questions, of course, for Chairman Powell. But TK, before we get there, you've got the meat of the statement and then straight to the forecast. I think for a lot of people, it's straight to the forecast.
The heart of the matter.
2023, how much movement are we expecting? Growth up, inflation down, maybe. Yeah. Show me the median dot. Do people start to nudge that extra hike away, maybe a little bit? Does that change the median? Yeah. And then out to 2024?
I think the dots are the most important thing this time. I usually don't say that, but within that is the background news. Is he going to address a strike in Detroit? I believe as Jamie Dimon of J.P. Morgan will speak in Detroit today. Maybe he's already done that. We're a bit out of the time zone here. But, I think there's a set of data and a set of global events right now, including China, that he has to allude to in this press conference. That's not seen in the dots. The dots are a pure U.S. guess. There's more going on than the dots.
So Andrew Hollenhorst of Citi is going to join us in the next 30 minutes or so. Andrew put out a note, publishing with the team a little bit earlier, Citi Economics, and they made 3 points, TK. One is the strikes with UAW. Yeah. The second was oil. And the third was house prices. I would pick up on oil and throw in China. Tom, oil and China were believed to be tailwinds at the start of the year. Energy was coming in, China was reopening. Are they headwinds now at the back end of 2023? Most people would assume they are.
What they are, and this goes to data dependency, there's something that's happened in the last 14 days. Maybe it's 20 days. I'm not keeping that count. But this surge that we've seen in oil, with Javier Blas looking at Saudi Light near $100 a barrel. I saw a 97 quote on Saudi Light spot, I think 48 hours ago. That's new, and that's new for the people at the Eccles building. They are data dependent, but it's just not economic mumbo jumbo. It's what's going on in the rest of the world, including China.
Neil Dutta of Renaissance Macro wants the last word going into the Fed decision.
He's one of our best guests.
Dutta writes in, this is wish casting from the Fed. They are wish casting a soft landing, but the reality of 2023 is that we have not landed at all. We're running at an above trend cruising speed. We'll get the forecast from the Federal Reserve in about 20 seconds time alongside that Fed decision. Going into it, the price action looks like this on the S&P 500, positive by 0.2%. On the NASDAQ, almost totally unchanged. To the bond market, yields on a 2-year shaping up as follows. Near in and around 5% on a 2-year in America, 5.05%. Mike McKee has the decision.
This is the very definition of a unanimous hawkish pause. The Fed leaves rates today in the range of 5.25% to 5.5%, while saying growth is solid and inflation elevated. So higher for longer. Policymakers leave another rate move on the table for this year and take 2 reductions off the table for the next 2 years. The statement once again discusses, quote, the extent of additional policy firming that may be appropriate. And the dot plot shows that 12 members of the Open Market Committee still believes they will raise rates by another 25 basis points this year. The high dot at 6.25% comes out of the dot plot with St. Louis Fed's Jim Bullard's retirement. For 2024, the committee now sees a median effective Fed funds rate of 5.1%, up 50 basis points from their June projection. And for 2025, 3.9%, up from 3.4% in June. The long-run neutral rate is unchanged at 2.5%, although the central tendency range moves up to 3.3% from 2.8%, and the dots show 7 members think that neutral is higher than 2.5%. All this because the Fed sees stronger growth, lower unemployment, and lower core inflation ahead. The economy should grow 2.1% this year, they say. That is up from 1% in their June forecast, more than doubling. They say next year growth will be 1.5%, up from 1.1%. Unemployment will finish this year at 3.8%, down from their June forecast of 4.1%, and the next 2 years end at 4.1%, down from 4.5%. PCE headline inflation will be 3.3% this year, up 1/10, basically on energy concerns. But their core PCE forecast falls to 3.7% from 3.9%. Next year, it falls to 2.6%. And one final note, no change in QT, no change in the IOR or repo rates.
Mike, stay close. I'm just going to work through the price action. So off the back of this decision, we're negative by, let's call it 0.2% on the S&P 500. As you might expect, the NASDAQ underperforming. If you turn to the bond market, yields were lower almost across the curve at the front end as well. They're now higher by 3 basis points. Looking at, staring in the face of the potential of closing at new cycle highs on the front end, 5.1287 turns to 5.13 on a US 2-year. So yields up, new cycle highs at the front end of the curve, and the dollar off the back of it a whole lot stronger. The euro against the dollar, 106.89 on the session, positive still by about 0.1%, but certainly off the back of that decision, a stronger US dollar. Mike McKee, I want to come to you on that median dot for 2024. Are you basically telling me the Fed took back half the cuts that were priced for 24 in their previous projection?
That's basically what I'm telling you, John. They were looking at 4.6%, and now they've gone up to 5.1%. Clearly, they think the economy is strong enough that they may need to do more. At least that's the message they want to send to the markets.
Mike McKee, I look at the growth forecast. You went through them quickly. Maybe they don't make the headlines. I think they should. Frame out again their growth vision, as Neil Dutta says, their wish casting for 2024.
Well, the biggest change is 2023. This year, obviously, the way things have been going, they need to mark up growth for this year. They call it solid. 2.1% is their final growth. But growth next year is 1.5%. That's up from 1.1%. That's a fairly strong change. So they do see perhaps the wish casting that Neil is talking about, the idea that growth can be stronger into next year. And it does certainly suggest the idea of a soft landing.
I look, Michael McKee, at where we are in this, and it gets to November and December. I know your first question to the chairman will be, tell me about November. Mike McKee, tell us about what this translates into for the next meeting.
Well, it's definitely going to put the markets on guard, depending on what kind of data we see, especially in the inflation numbers. The Fed's acknowledging that we're going to see a little bit higher headline, a little bit lower on the core. And if that's what we get, then the Fed could decide to raise rates. It's hard to know exactly because of the energy components that are coming into this, but that's what to watch for when we get the CPI and PCE numbers. The other, of course, joker in the pack is if the government does shut down and there is no data, the Fed will have to use its own kind of methods to figure out where it thinks inflation is.
Mike McKee, thank you, sir. We know you've got to run and get to that news conference. Mike McKee's going to sprint to that. It begins in about 25 minutes' time. Just to go through the forecasts again, that is a monster upward revision to GDP. But they're market to market at the Federal Reserve. So they go from 1% to 2.1 for 2023. Tom, the story for me is out in 2026. The story for me on unemployment, they've got it at 4% and PCE back down to 2%. All the way out there, several years away, and this is the aspirational, fanciful stuff that this is how it's going to happen. Unemployment for this year, by the way, 3.8% is the forecast now, and it only climbs to 4.1% next year. Bruce Kasman talked about this a little bit early this morning at JP Morgan. Tom, how high does unemployment need to go to get inflation lower? That's going to be a question we could explore in the next 25 minutes or so. But the Federal Reserve is telling you that they can get back to target 2% in several years' time, and unemployment's going to be in and around 4%.
I'm going to go with Dutta here and combine it into what Matt Lazzetti said. I got lucky in that I picked out of Matt Lazzetti's note his first look at 2026. I don't even know if there's a first look to first quarter 2024. The uncertainty here, off the pandemic, off the shift from a supply analysis to a demand analysis of the economy, and that's a pretty clumsy move. John, I looking out to 26 now, maybe they're forced to do that, but boy, that's a tough thing to do. Let's do this, and we're very lucky today to do this because we can fold in what you're all reading and feeling about the strike in America. Diane Swank is steeped, I should say, in Midwest economics, her tenure at Bank One, and of course her academics at Ann Arbor. Andrew Hollenhorst with us as well. Diane Swank, I guess the chairman has to mention the strike today. How do you fold strike analysis into the chemistry the Fed has?
It's really tough. I don't think it. First of all, the strike is very targeted. We'll see over this weekend how far the strike gets. I think many people are worried about how long the strike will last, and that is important. It both suppresses economic activity, of course, constrains inventories, but it's constraining inventories in a different way than the chip shortages did. So I'm not as worried about vehicle prices being the push on inflation that they were, that some people are, given that this is a more limited kind of production hit, and it actually gives market share to other producers out there. At the same time, demand has fallen quite dramatically for new vehicles because financing rates have gone so high. I think what's really important in what the Fed just did was the whole concept of higher for longer, much higher for longer, and potentially a higher neutral rate on the other side of this. This is what the theme was coming out of Jackson Hole Symposium, was how synchronous the idea of higher for longer longer mantra is across the developed economies, that even as we approach this peak in interest rates, that the central banks are emboldened because of the resilience that we've seen even in those economies that have suffered recessions, have not been as bad as they expected, that they are emboldened to hold rates higher for longer. And there is a concern on the other side of this that they're going to need a higher neutral rate. This is a different world than the world that we left in 2019.
Far different, far different. Andrew, at the start of this hiking cycle, we asked a pretty important question. Can we get inflation down to target without doing too much damage to the labour market? Overwhelmingly, people said we couldn't. We've made some progress without killing off the labour market. The Federal Reserve today, Andrew, is extrapolating that out. How hopeful, Andrew, is that forecast?
I think that's the big question that these forecasts raise. You have 2023 growth revised materially higher. You have that strong growth continuing into 2024 now in their forecast. So you have an economy that's running at or above potential. You have an unemployment rate that's historically low. And yet we're meant to believe that wages and prices will cool in this economy. This just contradicts basic macroeconomic theory. So this is a forecast that does not line up with traditional ways of forecasting the economy, with the relatively intuitive idea that when labor markets are very tight, that pushes up wages. And when labor costs are rising, that pushes up prices. So I think this is a difficult forecast to square with the reality of how economies behave. That's to be addressed at a later point. I think what the Fed did today makes sense in the sense that we're running strong growth, we're running inflation that's above target, so it makes sense to guide towards higher for longer. So they achieved the hawkish skip. If that was the intent, that's achieved. I think in terms of the forecast, there are some real questions that need to be answered.
The hopes and dreams of these forecasts, Dan, let's sit on it. I remember a word that you used maybe more than a year ago. You referred to the forecast from the Federal Reserve as fanciful. Aspirational was a word we heard again this morning, repeated through this afternoon. Dan, when you look at these forecasts further out, do you think it's the right approach to extrapolate out current dynamics, which essentially is the following? Inflation can come down, can come in further without doing real damage to the labour market?
I think it's a great idea, and I hope they're right. I do think it is still fanciful. One of the things that I think that the Fed is betting on is that we are seeing the high-frequency data as the labor markets have cooled. This has been one of the most dramatic, frenzied pace of a labor market and then cooling that we've ever seen, with unemployment still very low. And what they're counting on is the high-frequency data on job postings shows that wages are slowing even more rapidly as we go into fall. So they're betting on those things, helping them. At the same time, we haven't seen in decades as many strike actions as we're seeing right now. And that's where things like the current strike with the UAW, the strike that we're seeing in healthcare, the strikes that we're seeing ongoing with the actors and the writers union, those things will have an impact. And how much we see the cost of living adjustments baked into contracts going forward is going to be very important. Remember, with the pop in energy prices, we're going to see an increase. The September CPI is what sets the numbers for Social Security bump in January.
Right.
That's one of the reasons. It's going to be a higher bump now. That's one of the reasons we had stickier inflation at the start of this year. And so that could be a sticking point and be harder for the Federal Reserve.
Andrew Hollenhorst, you need a victory lap right now. We got a 5.13% two-year yield. I've got a 10-year real yield any moment to pop through 2%, 1.99% right now. How does our economy, how does our business society, how does it adapt to a 2% real yield? Is that a signal of buoyancy and resilience, or is that a signal of trouble to come?
You know, we've seen the economy a lot more resilient to higher interest rates than I think many people expected at the beginning of this rate hike cycle. And part of that is that a lot of the debt that's out there is fixed rate debt that doesn't mature for many years. You think about 30-year fixed rate mortgages, many of those are still at lower rates. You think about some of the corporate borrowing that's taking place, and that also hasn't all been refinanced yet. So as that debt is refinanced, you start to have people, individuals, and firms experiencing higher rates. That should slow the economy.
Right.
You see credit that's tightening. So there is a sense that this is slowing the economy, but it has to be sustained. And I think that's the message in the dot plot.
For Bloomberg Radio Worldwide, bring up the chart again on television here that we just put up with the 2-year yield back to before the pandemic. And this is an arch call by Hollenhorst, and Swank was very good at this as well. Andrew Hollenhorst, we're back to yields that I remember and Diane Swank doesn't remember. The consensus belief out there is, OMG, we're all going to die with this yield structure. We're going to a 6% 2-year Hollenhorst yield. Are we all going to die?
Well, remember the 2005 to 2007 period. This was an extended period of time when the economy performed relatively well and we sustained higher yield levels. And it wasn't that long ago, but it just feels like a long time ago, and many people haven't experienced that yield environment. So I think this is kind of rediscovering that economies can continue to grow, continue to produce inflation at higher yield levels. Eventually, these levels may be restrictive enough, sufficiently restrictive in the words of the Fed, to cool the economy, but that's a process that can take time.
Diane, you're one of the best at this. Give Mike McKee a little bit more help. What's the question for Mike for this chairman in this news conference that starts in about 15 minutes' time?
I really want to know about how they're so optimistic about growth for next year, given some of the headwinds that we face going into next year, everything from higher oil prices to student loan repayments, and the additional tightening that they expect in the pipeline, not only in the banking sector, but more broadly. So, that 1.5% is really pretty stunning, with 0.5% higher on short-term interest rates. That's remarkable resilience with the cooling of inflation. And I'm just trying to square how that all comes together.
Yeah.
Oh, Diane, we all are. We're trying to figure this out. Diane Swank there and Andrew Hollenhorst, two of the very best on the Federal Reserve. That news conference starts in 15 minutes. If you're just joining us, welcome. Special coverage of the September Federal Reserve decision, live on TV and radio. A Bloomberg surveillance special alongside Tom Keene. I'm Jonathan Ferro. The decision, unchanged, no change on rates of the Federal Reserve. The focus on the projections of this Fed, a monster upgrade to GDP for this year, in many ways marking to market. No news there. We understood that growth was better than expected through much of this year. They understand that now. The new projection is 2.1%. The old projection was just 1%. An upgrade to the GDP forecast as well for next year too, for 2024. That goes from 1.1% to 1.5%. Some of the projections elsewhere are pretty fascinating. 12 of the 19 officials on the FOMC still forecasting, plotting an extra hike this year in 2023. In 2024, the median dot, we priced out half the cuts they had projected in the previous set of forecasts. But ultimately, it's the soft landing hope and dreamed. The decision, Tom, today is to extrapolate out current conditions. The idea that we can get back to target, all the way back to 2%, without seeing unemployment climb much higher than 4%.
We had a banner up moments ago on television here, and I did the quick nominal GDP math, and this is basically out 24 months, out 36 months, out to when we turn into a pumpkin. John, it's simple. They're looking at 4% nominal GDP or lower. And there's a lot of people looking at the spirit of this economy, saying that with disinflation, that maybe strengthens the economy, and it's to bust Bramo's chops, it's a toxic brew.
It is a toxic brew. But for them right now, there's nothing toxic about those projections.
I can't get out to 25,
Max Kettner.
26.
We said Max Kettner, HSBC. Yeah. He started talking, and we said that sounds like Goldilocks forever.
Yes.
Aren't those projections Goldilocks for the next 12 months?
I would.
The rest of this cycle?
I would say so. And what's interesting here, folks, we're coming to you from London, is, those of you on TV can tell the sunset is spectacular tonight. I went out on the sidewalk in the rain here, the lovely afternoon rain.
How did that work out for you?
Of London, practicing for Bank of England tomorrow. And this jumble that we're seeing right now in America is the same exact theoretical jumble we're going to see tomorrow with the Bank of England. These people are making it up as they go.
Let's turn to the price action and see how much Chairman Powell has to say in the news conference that starts in about 13 minutes. Your equity market totally unchanged on the S&P, slightly negative on the NASDAQ, but this move in the bond market, Tom, let's sit on that. The 2-year cycle highs
that's a key thing.
Through 5.1%, just like that, up by 3 basis points on the session, Tom. Yield on the 10-year, not much price action there, 434. 30-year, let's call it 440 TK on the long bond.
Let's bring it in right now. This is very important. PGIM's Greg Peters with us on yield and Jim Bianco with us with Bianco Research. Jim, let me go to you right away. I just think this is so important. There's a sense of longer. I see a nominal GDP call out 24 months, which is not longer. It's that finally rates come in. Do you buy it?
Well, I buy the idea that you want to be looking at GDP, nominal GDP, as being a benchmark for long-term interest rates, but I'm not buying this idea that nominal GDP is going to fall to the levels that they think. If I was to describe, this confusion that we seem to have about this Fed policy, they're almost arguing that nothing of significance happened in 2020 and that we're going to return back to normalization, is the word we like to use that's replaced transitory, and go back to something between 2010 and 2019 where we can have 2.5% real growth, 1% to 2% inflation, 4% nominal growth, and that would bring everything down and you'd have Goldilocks forever. But I'm not so sure that that's the case. I think that the economy has changed since the shutdown restart in 2020, and the Federal Reserve is still struggling to come to grips with that, and they're still thinking we're still in the last cycle.
Greg, you've got to work with real money here. The decision to extend duration, to find the belly of the curve, all the other professional stuff you do at PGIM. Does the language and the nuance of the forecast and the dots, does that change your conviction in what you're doing with your portfolios?
Well, I would say that we're finally getting what we've been thinking for quite some time, and that is higher for longer, right? The markets have been raging against this notion that rates will remain high. All the forward curves are pointing down, the dot plot pointing down. So I think this really throws cold water on that. And so for us at PGIM, we really think it's a higher for longer. We never felt the need to jump into duration. Maybe it's closer to that now, but more in the back end of the curve. So look, I think the Fed delivered exactly what they wanted to, provide a hawkish sap that allows them to speak more dovishly and perhaps not move rates higher here.
Greg, it's not just the high for longer message that jumps off the page of the SCP. It's the growth inflation mix looking out a year, 2 years, that they believe you can get back to target 2%, and unemployment's going to drift higher, maybe to 4%, and basically stop there. Greg, that has big implications for how you invest elsewhere, beyond rates, bonds, and to credit. Is that your outlook, that basically we can achieve back to target inflation, barely shaking up the labour market in any way, shape or form?
Well, it is very aspirational. There's no doubt about it. That is a Goldilocks type of outlook. If you have an environment where, rates remain higher, but growth is quite robust and inflation's coming down, I think that is a fantastic investing backdrop. I do think we're pretty close to it. The challenge, of course, on the table is all these different uncertainties and cross-currents, and that has not gone away by any stretch of the imagination. So, we need to take these forecasts with a grain of salt. There's no different than our own forecasts, right? They're rife with uncertainties, but I do think there's a distinct possibility here, at least directionally, and I feel pretty good about the outlook.
Jim Bianco, do you feel pretty good about the outlook?
If we're talking about the outlook about the Fed, I have my issues with it like everybody else, but to feed on something that Greg just said, let's be real. We all have forecasts, and most likely they're all wrong, but that's okay because we're not being expected to predict the future. The key is whether or not we can adjust. We can see that, okay, the data's coming in not as we expected, and we need to adjust these forecasts. Now, the Federal Reserve in the last couple of years has not had a good track record on that. We can all remember transitory. And what I'm afraid of with this Goldilocks forecast is when the situation comes in that it's not panning out, they're going to dig in their heels and continue to say it will, and they might wind up making another transitory type of mistake in 2024. I'd like to see Chairman Powell, show some flexibility with these forecasts to say, look, this is what we think now. But if the circumstances and data comes in soon, that's out the window and we're going to adjust. And that, like I said, that is okay. That is what you should do with a forecast, not just keep at it because you're afraid of some embarrassment of having to change it.
Jim Bianco, the laureate Paul Krugman, with a wonderful essay on disinflation, and he really emphasized what the Fed doesn't look at, which is plain vanilla inflation. Are they just in the fog of London, in the fog of Washington, the fog of across America, are they missing a disinflationary tendency in place?
I don't necessarily think they are missing a disinflationary tendency. I happen to be in the camp that inflation on a year-over-year basis, I'm talking about headline CPI, has bottomed for the year. It's going to drift towards 4%, not much higher than that.
Wow.
Energy prices are going to be a big factor in that drift higher. And that will be enough maybe to give us that one more rate hike that they're looking for and to at least justify going from 4 to 2 cuts next year. And I think that if that continues, that the December update of this plot will probably take those 2 cuts away as well. So I'm in that inflation is sticky camp, and that the Fed is going to have to come to the realization that they're not going to get close to 3%. So the disinflation that they're hoping for, that inflation comes down, the unemployment rate could stay at 4%. It's been described here as fanciful, and I would also be in that camp too, that it is fanciful, and we'll have to see whether or not that type of situation unfolds.
John, moments ago, rounded up the 10-year real yield to 2%. This speaks to Dominic Constant Mazzuo's idea of we are restrictive.
Forgive me for thinking out loud, gents. There's a very simplistic approach to markets. You get economic information, data, you think about what it means for the Fed, and you trade accordingly. Now, Greg, I wonder if that's just changed off the back of these forecasts from the Federal Reserve. And let me go one step further and explain why. The first Friday of the month, we'll get a payrolls report. And if that payrolls report is hot, typically we'd sit there and say, well, labour market pressure, higher inflation, Fed has to do more work. But, Greg, hasn't the Fed just told us, haven't they just de-emphasised the importance of the labour market to the inflation conversation?
Jonathan, I think that's putting way too much emphasis on the SEP and the forecasts. I mean, at the end of the day, we're in this data-driven world. The Fed is trying to balance that out. And I think the markets, given the fact that we're in this data-driven world and we're not getting what we're wanting in terms of clarity out of the Fed, we're relying a little too much on this data release. So I don't think anything changes. I think if the data change, I think the Fed policy changes. And, it's also important to remember 2 things. One is that, they don't have inflation going down to, 2% until 2026, which is, quite some time from now. And then 2, we just had a massive revision of GDP in this year. So, let's use that as kind of a reminder that forecast error is really quite high here.
Jim, what are your thoughts on the same question?
Yeah, if I could give you a cynical thought, that is that let's see if we even get a payroll report on October 6th, because if we have a government shutdown, the BLS is closed and Mike McKee's sitting in front of an empty building on that morning. So leaving that aside, I do think, though, that if you're talking about the payroll report, the consistency about it it's been much stronger than we've been looking at for the last 14, 18 months or so. All but something like 2 or 3 of the reports have been above consensus. And that seems to be the trend that I would think would stay in place. And if we see those kind of numbers come in, it's going to push everybody firmly into that, away from that Goldilocks and into that higher for longer camp as well.
We got to make some money to get home here, John Ferro. Ian Lingen, the screaming buy of the 10-year yield, just says this is a Fed doubling down on soft landing. Mr. Lingen, of course, at BMO Capital. Greg Peters, if they're doubling down on soft landing, for you at PGIM, is the 10-year yield a screaming buy?
No, I don't quite understand that logic, to be honest with you. I mean, what that would presuppose is that you'd have a healthy dose of cuts in response to that soft landing. So, no, I think yields are relatively range-bound here. I don't really see a big move either way. Yeah, it does look a little oversold. There's some technical dynamics, but ultimately on a medium-term basis, it looks pretty fair value to us. So I don't think the bond market, investing in the bond market is not about capital appreciation. That is a pre-pandemic trade. It is about roll and carry. And so, no, I don't expect it as a screaming buy.
With that in mind, Greg, if there's a pool of money people sitting at home right now, they're sitting on the front end. They've been told by a couple of people that they should worry about reinvestment risk in the next 6 months and allocate accordingly further down the curve. Are you saying relax, patience, you're fine where you are?
Yeah, so I've been saying that the whole time. No one wants to listen to it, right? I think there's been this tendency to jump back into the pool because these higher rates are going to evaporate. What the Fed has told you today, what the markets are finally starting to respond to, is that no, these rates are actually around here for a while. So, yeah, so I don't think there's any reason to rush. And so we like duration, but we wouldn't go hell's bells. Sorry.
And let's fold this into Jim Bianco. I mean, John, it's just simple. Bianco was way out front with this idea of defining what longer looks like with a 10-year yield, and he's in the camp with Greg Peters.
Hey, Jim, this was great. Jim Bianco, together with Craig Peters. Thank you, guys. Going into this Federal Reserve news conference with Chairman Powell.
Bloomberg surveillance. The Fed decides.